Hello, I'm Jeremy Owen from your investment team. I just wanted to take a few minutes today to share our 2019 market outlook with you. Our research believes U.S. economic growth expectations should be lowered in 2019 and forecasts U.S. gross domestic product, or GDP, growth ranging from 2.5% to 2.75% in 2019. The still meaningful positive growth will be supported by consumer spending, business investment, and government spending. Based on expectations for economic growth and monetary policy, along with fiscal tailwinds of government spending, reduced regulation, and lower taxes, we expect 2019 may be a good year for U.S. equity investors. We are forecasting slightly above average returns for the S&P 500 index for 2019. Our total return estimate is in the range of 8 to 10% when including dividends, as measured by the S&P 500 index. We believe much of this growth will be driven by potential earnings per share gains in the range of 6 to 7%. With market interest rates climbing from historic lows, bond investors must be prepared for continued gradually rising rates with periodic surges that may temporarily affect sentiment. As a result, we expect flat returns for most traditional bond assets in 2019, as measured by the Bloomberg Barclays Aggregate Index. Fiscal stimulus did its job in 2018, with the U.S. economy growing at an average of 3.3% over the first quarters, compared with expansion averages of 2.3% GDP growth. While again, we believe expectations should be lowered in 2019, we continue to expect that the ongoing impact of fiscal stimulus will be readily apparent, supporting above average growth in the U.S., supported by modest inflation and excellent unemployment numbers. We favor emerging markets over developed international equities for their solid economic growth trajectory, favorable demographics, attractive valuations, and the prospects for a U.S. trade agreement with China, with a bias toward emerging Asia. Growth in Europe has been slowing and may struggle to even reach 2% in 2019, while growth in Japan is also lagging, despite stimulus and corporate reform efforts. GDP growth in China and broader emerging markets is likely to more than double the pace of developed international economies in 2019. And we believe political uncertainty is actually higher in Europe than in emerging markets. The hot topic of this year's economic concerns continues to be U.S. trade negotiations. U.S. trade will likely continue to make headlines in 2019. Though tariff talks and trade tensions with China remain, progress has been made with South Korea, Japan, Mexico, Europe, and Canada, which supported positive market sentiment in the third quarter of 2018. Moreover, the conclusion of the recent G20 summit in Argentina resulted in a sort of trade truce, whereby the U.S. and China committed to working on a more lasting trade resolution within the next few months. Although tariff threats may seem scary, trade represents a small portion of the overall economy, and the fiscal measures should more than offset the potential negative impacts of tariffs in 2019. Even though we expect a resolution, if it takes longer than expected to reach an agreement, then it's possible that the continued trade discussions could further weigh on market sentiment. The ongoing uncertainty could have a greater impact, potentially slowing the pace of business spending or the rate at which fiscal stimulus will take effect. However, despite all the attention given to tariffs, world trade has been growing at a steady pace. Despite periodic slowdowns, business spending was robust in 2018. If this trend persists, it's possible the cycle may elongate even further. Surveys suggest that business spending may grow at a solid rate of about 7% in the year ahead, such that early signs of a slowdown could prove to be temporary. per the Institute of Supply Management's Manufacturing Purchase Managers Index. High business confidence should support increases in capital and equipment purchases. Investors' obsession with the flattening U.S. Treasury yield curve dominated headlines for much of 2018. A flattening yield curve occurs when short-term rates are rising faster than long-term rates, which may eventually lead to an inverted yield curve, where short-term rates are higher than long-term rates. Historically, this has been a negative signal for the U.S. economy, often providing an early warning of an eventual recession, which is why the yield curve has been garnering so much attention recently. We believe these concerns were overstated given the positive economic environment. We do expect both short and long-term rates to gradually rise in 2019, keeping the yield curve somewhat flat. However, if that continues to occur in the context of solid economic growth and modest inflation, we don't think a flat yield curve should be read as a signal of rising recession risk. The current bull market is officially the longest in history, and the economic expansion is quickly approaching that milestone as well. It'll be the longest expansion ever as of May 2019. So what does age have to do with it? Considering that on average the typical bull market and expansion last approximately 5 years, reaching the 10-year mark is quite a feat. But for those who are concerned that the cycle has gone on too long, there is some interesting context to consider. Assuming the start of the current bull market began after the lows achieved in March 2009, then it is the longest in duration, but importantly, not the longest in magnitude. Here are some investment ideas to consider. Are new and noteworthy, meaning your book club may thank you for these recommendations in 2019. U.S. stocks, superior economic and profit growth and fiscal stimulus provide an edge over developed international equities. Value stocks, economic growth tailwind and attractive relative valuations compared with growth may help buoy value stocks this year. Cyclical stocks, solid economic growth may support economically sensitive sectors. Emerging market stocks, strong growth, attractive valuations, and potential U.S.-China trade agreement may help emerging market equities outperform. Investment-grade corporates, economic growth may help credit-sensitive bonds. Added credit risk provides increments in yield. Mortgage-backed securities, yield benefit relative to rate risks remains attractive among high-quality bonds. Our classics. Don't count on these timeless tales. These investments should provide a solid background to your portfolios. Small cap stocks. Tax reform benefits starting to fade and cycle is aging, but domestic focus may help in early 2019. Intermediate term high-quality bonds offer some potential diversification benefit while avoiding the rate risk of long-term bonds. Bank loans, still potentially attractive for strategic investors, but high issuance, weaker investor protections raise some real concerns. High-yield bonds may be supported by further economic growth, but we prefer a combination of stocks and high-quality bonds. Out of print. Might have to wait for the next edition. These investments aren't gaining traction yet. U.S. defensive stocks. Less economically sensitive sectors may offer lower return potential amid solid economic and profit growth. Growth stocks. After a sustained period of strong performance compared with value, the growth stock rally may be due for a pause. Developed international stocks. Growth in Europe has slowed while political challenges are rising. Developed international bonds. Valuations remain very rich, and declining central bank accommodations may create a challenging environment for these bonds. long-term, high-quality bonds. With rates expected to rise, the diversification benefit may not adequately compensate for added rate sensitivity. Thank you so much for your time today, and I hope you found this video helpful. Thank you so much for your business, and please do not hesitate to reach out to us with any questions.